This is so fun. I've never met Greg before, actually. We're about to talk to Greg Bond, who is the CIO of the world's largest publicly listed hedge fund firm, Man Group. It has almost $230 billion in assets under management. And we're about to talk to him about how he's using AI to improve the investment processes at Man Group and also manage risk.
This kind of quant discretionary impact of AI.
So if you're building a company in AI today and you want to know what the biggest finance minds are thinking in terms of what they need, this is the episode to listen to. Welcome to the latest episode of The Bridge by iCapital. I'm Sonali Basak. I'm the Chief Investment Strategist at iCapital, and today I am joined by Greg Bond. He is the CIO of Man Group, the world's largest publicly listed hedge fund with almost $230 billion in assets under management, and he also is the lead manager of the flagship multi-strategy portfolio at Man. Greg, thank you for joining us today.
Great to be here.
It is really the moment to talk about hedge funds. There's been so much excitement around them, but even more so than excitement around hedge funds, quantitative hedge funds. What is different about this moment? Because quantitative hedge funds have existed for decades, but AI is kind of changing the game here.
Yeah, I mean, it's very interesting. People talk a lot about the markets and people, constantly buying the dip on the kind of the beta of the world, but also for hedge funds, as you say, it's been a really robust market, not just for quant, also discretionary. And so the question is that alpha related to the beta and the market that we're seeing? Is it actually diversifying? And so we have seen strong performance in quant strategy specifically. Largely, I think, with interest rates coming back up to more normal levels, it's been really good opportunities for dispersion trading, different opportunities in the market, and maybe just enough sort of shocks in the system to create that dispersion.
So it's interesting. I've got to say, it's always the case that people think about the beta that they're taking on, but I've heard the word beta more in recent months than I have maybe ever. And I think it's because we've been in a relatively one-way market for years now. I mean, of course, there have been hiccups, but do you think that generally speaking, you have a lot of people who are kind of in wolf in sheep's clothing, if you will, just kind of wearing a lot of beta in their portfolios and calling it alpha?
I think so. And I think that's where I spend a lot of my time running our multi-strategy portfolio. Because again, we have seen, you're not supposed to see this correlation between alpha and beta, but alpha's been strong while the markets have been strong. So really a lot of digging into strategy, seeing what their true drivers of performance are. It's not some sort of hidden beta. You see this a lot in maybe some long-short discretionary hedge funds, at least historically. They do carry some market beta. But theoretically, and particularly on the quant side, you're supposed to be neutral and try to control that exposure. And is it actually controlled in your portfolio? I think we've done a good job in the quant community, but beta can mean other things, not just market returns. It can mean factor returns and what are the key drivers there and trying to understand, because we have seen in this market in the last, really post-COVID, the answer has been to really keep your gross exposure, your leverage up. We sort of largely absorb some of these small dislocations. We'll call them quant quakes, but I think it's even broader, kind of call them discretionary quakes as well. And some of that might be the rise of multi-strat platforms and just a lot of linkage there that hasn't been in the market historically. And so the question will be in the next quake, if it's more than a 2 or 3 week event, from a market's perspective, what do people do? How do they react? I know that the prime brokers are a little concerned about the amount of leverage it's been in the system.
Are you?
Well, I think it's something to be very careful with. It's really hard competitively, right? You want to keep your returns. Your investors are paying you to take risks, so you want to keep that risk on. It's really hard to call these quakes. So I think one of the things that we try to look to is liquidity, right? Having liquid strategies, whether again quant or discretionary, allows you to adjust at least to real-time information. And there are other quant strategies like trend strategies that might actually be quite helpful in some of those sustained drawdowns. So you go back to first principles around liquidity and diversification, and hopefully you have true diversification. So right now, while the markets and things are working fairly well, make sure that you actually have alpha in your portfolios and that's not a hidden beta effect.
It's really interesting. I thank you for bringing up kind of the tough times here, because even though quant is exciting, it's the flavor of the week, so to speak, it's been a tough couple of years in that it's kind of been popular and then not popular, then popular and then not popular again. Describe that ride that you have been on.
I mean, and I've been in this for over 20 years, if you go way back, and I've been through the August of 07 event, you go through 08. I joined right after the internet bubble, so early 2000s. So I avoided that one, but we've been through, and then the kind of the quant winter or value winter from 18, 19, and 20. And so one of the things that I've seen is these strategies do come in and out. They work in different environments. Clearly, the more recent environment's been pretty good. I think we've also seen more diversification across quant managers, which I think helps. When I first joined, maybe we had a couple of models, and now we have, however you want to count it, hundreds of models, different techniques. And so I think the manager set itself has been a bit more diversified, and people are better at managing maybe their liquidity risk, because I think historically, particularly in the early 2000s, there was a lot of exposure in small cap stocks, other things that people probably weren't managing as effectively as they should. So we're in a new regime, but that brings up all kinds of questions around crowding and positioning. Are quants different, and how to think about that? So new questions.
Differentiation within quant strategies, I think, is enormously important. We got through cleanly, generally speaking, in the markets, despite enormous amount of risks that were over the horizon. Yet we got into July, and it was choppy, right? The first week of July, you saw the Philadelphia Semiconductor Index drop more than 4% in the first week. You had a headline crossing the Bloomberg terminal and quants having the worst couple weeks since 2023. But that's not really the reality that we're seeing across the market, actually. There's enormous dispersion. How do you explain how, from where you sit, you navigate these moments where the dispersion kind of gets interesting for investors?
It's interesting. I think one of your key principles is to make sure that you can keep your capital in play in those dislocation events. Again, the playbook has been generally to buy into those events, or at least hold your exposures, and that's worked out fairly well, being diversified going into it. I think what's been interesting about some of the flows and other things that go on is people delever. Maybe it's multi-strats, maybe it's other kinds of strategies. There's things you just have to be wary of. One of the things that we try to keep an eye on are sort of short interest, other kinds of I guess that's become more of a traditional factor, but not something that's historically in the traditional factor set. Obviously, momentum risk, those kinds of things. And one of the frustrations in some of these events is that the stocks sell off, yet actually their earnings revisions have been quite positive. The underlying fundamentals are quite healthy. And it's hard to make that, that connection, why that's happening. And I think one of the things that we have done, and particularly on the quant side, is some people have gone to shorter horizons, but we've also gone to longer horizons. And so we have a few signals that we call sort of long-term alpha signals that I think hopefully if you can stomach the ups and downs are more like an investing strategy rather than a trading strategy. So I think you can diversify not only in the kinds of models, but also your horizon. And I think that might be interesting, because I think you're seeing a lot of the higher frequency players go into mid-frequency, a lot of the mid-frequencies maybe going into higher frequency. So there's a lot of competition in that shorter horizon.
So in that shorter horizon, I think these moments are so important because these are the make or break moments.
Right.
This kind of shows, what a fund or what a strategy or what a PM is made of in so many ways. I do think also the reason this moment is so important is because the role momentum is playing in it. What is this moment saying about this momentum-driven market and how exposed people are, perhaps, if they want to be or not?
Yeah, I think we keep an eye on what we would call our form of momentum, that we look at a variety of signals and horizons. And we also keep an eye on the generic momentum models and what the exposures look like. And, it's not that we want to necessarily bet against those more traditional factors, but hopefully we're bringing something that is different. Now, I caution, people talk about idiosyncratic models all the time, right? And being different. And part of that's valid. Like, you want to be different and you want to be able to measure, okay, how much risk do I have in more traditional factors versus more idiosyncratic factors? But there's a little bit of FOMO in the market when everybody's chasing ideo. Does ideo become the new factor? And so some of the deleveraging events, things that we see that happen, are often in the more idiosyncratic part. Maybe some of that's traditional momentum, but it's also just in some of these, in the pod shops and other places and in what we do, sometimes the pressure counterintuitively is on the theoretically more interesting or idiosyncratic part versus the more traditional model. So that's something to keep an eye on. What's the right balance between, buying cheap stocks with good quality, good earnings revisions versus new data, new techniques, other things that you might have in your portfolio.
Okay. So I'm going to have us take a step back and really describe this for a second, because when it comes to momentum, are we saying that it's your friend or not?
Well, over long periods, momentum does pay off. We have parts of it in our portfolio. I think you can define momentum whether it's price-based action or more fundamentally driven action, right? I think at the margin. We like fundamentally driven, good earnings revisions, other things. I think there's been a lot of powerful concepts in our world where you don't look necessarily at a specific company, but you look at the companies around it, right? It could be supply chain, it could be other competitors. And as you do that and get the sort of the ecosystem, if you will, of a company, sometimes some companies are just a little bit late to the game. And if you can estimate your model globally, looking at across what are emerging market semiconductor stocks doing versus the US, and maybe something happens over here before it happens here, and therefore you can maybe take an advantage. So just diversifying, that's been really, really important. And then other concepts of momentum, it's a lot of the newer applications in the last 5 to 10 years of machine learning models. Maybe there's interesting relationships that maybe momentum behaves differently in really volatile stocks versus more, safer stocks. And so a lot of conditional kind of momentum then starts to be deployed in portfolios. So it's a more nuanced exposure, but the headlines are, okay, stock goes up, you should buy more. Stock goes down, you should either sell it or short more. But that concept has become much more nuanced and hopefully allows people to manage some of these kind of generic drawdowns, because there have been the rise of generic factor baskets that people can buy quite cheaply. I think people use that at the margin to adjust positioning. I think discretionary managers often use those baskets to help hedge what they're doing.
I do want to kind of just, quick game of this or that. Okay.
All right.
So if we think about momentum, who's a bigger driver in the market? A hedge fund community or the retail community?
In terms of capital, retail, I think, is coming up. And I think for specific names that have interesting liquidity profile, smaller cap, often you can see retail. And we've seen some of the meme stock craze. There's definitely pressure that can be deployed quite quickly from a community into a particular set of stocks. But I think in the broader space, to me, it feels more discretionary or quantitatively driven. And I think we see that a bit even on the discretionary side, where there's a certain kind of stock that's typically, I don't know if you want to call it a hedge fund hotel type stock, but things that have underlying momentum, maybe a growth story, other things that if you look across broader portfolios, we spend a lot of time on this. Where do we have our momentum exposure? Is it from the discretionary side or the quant side? How do we manage that? So that's been a lot of fun part.
I have not heard that term in a minute. Hedge fund hotel.
Yes.
How many are there right now? I mean, how often?
Well, I don't want to get into specific names, but when you go to these conferences, and I go to a few, there'll be maybe the person that's doing a big talk, there'll be 5 to 10 names that
But
come
that crowd mentality is,
yes.
it is a double-edged sword, isn't it? It's finding names or industries that everyone wants to crowd into, and that drives the momentum, but then it's painful on the downside.
It is. And so, again, momentum works over long periods. It's very hard to time. And so what you try to do is, can you extract what the true trend is and try to remove as much as possible the generic part? So again, if stock's up, but it's driven by interesting relationships between volatility and price action, or you have other new data that's telling you should be, that's good. You have high confidence, but just generically.
Playbook on how to enter the hedge fund hotel.
Yeah. And avoid that if you have those names. And you can see, and some of that is frankly just looking at short interest. That's a good way to either stocks that are heavily shorted or stocks that aren't shorted, right? Kind of gives you that.
So if we think about the last, let's say, couple years, right? When we saw big drawdowns, is it too simplistic to say that much of those drawdowns were momentum on the wrong side?
You could maybe say that. I think there's been some other trades that have blown up in other parts of portfolios. Index rebalancing trade, where people try to play their index, that can often have a contagion effect into more traditional strategies. You hear stories of quant books being shut down, either at pod shops, or a lot of the large sovereign wealth plans have their own kind of hedge fund books, other places around the world. And so there's a little bit of what's causing it. You can't always explain it, but there could be a story that it's one of those places, maybe deleveraging, or you're just in a market, you have calendar effects. Maybe you're coming into a June 30th and you're thinking, okay, maybe I want to have a slightly different quarter end position, or you see on the discretionary side, people will take down risk going into December. So there's a lot of behavioral things in the market that aren't necessarily related to the underlying fundamentals. Hopefully you're there to play around and take advantage of it. But the critical part is to be liquid, manage your risk so that you don't get blown out in those really sharp sell-offs.
Right. Risk management is a very
important
part of the process here. So to that end, on risk management, I mean, how do you effectively risk manage? What are some of the qualities that you have to really own right now?
Yeah, I think first of all, there's just put risk models to the side and quantitative techniques and all. Really, some of it's philosophical. Like, do you have okay, these kinds of quant strategies, which are more traditional, maybe some that are a little bit more idio. Oh, I've got a discretionary PM over here that looks very, very different. Maybe they focus on financials or other sectors, have a very different approach. Maybe you've got other systematic strategies like trend, which hopefully. So the key is just from a first principle, start there. Don't rely exclusively on quant and long-term correlations or short-term correlations, because you don't know ultimately when you get into that moment of stress, you want to be prepared. So I think first principles, and then there is a lot of monitoring. I think I found a lot of benefit of just having a common toolkit as we look across discretionary and systematic to see how that all rolls up into a portfolio, particularly if you have things like trend that are changing your exposures to the various markets across the world. So I think that's really, really important. Liquidity is really, really important, as I mentioned. So where are you sitting? It's great. Emerging markets, small cap have great alpha opportunities, but you're also trading off with liquidity risk. So where are you getting the best bang for your buck in the strategy? Maintaining the right amount of liquidity, capacity is really, really important. And then just being ready to have a playbook ready to go about where you want to deploy. Maybe you start rather than delever, maybe you just don't reinvest. So there's a lot of playbooks that we try to go through so that we're prepared. But obviously every crisis is a little bit different.
When we think about future drawdowns, one question I have is, so much of this is a matter of market structure. Is there something about the market that we're in today that is more vulnerable to shocks, to volatility, just based on who's operating within it?
Yeah, I think you've got the rise of multi-strat, right? And I think there's a lot of compelling structural reasons you want to have that kind of approach as an investor, right? You can put together many, many strategies that the manager that's running it can see the real-time risks. They can get the volatility up to something that's more reasonable versus you going off and buying 10 hedge funds. You're not going to get a lot of volatility from that or exposure. So you're not getting sort of this problem with you put $1 in, you're not getting a lot out of it. So multi-strats help with that problem because they can theoretically deploy leverage. And I think so that's been a great structure for folks. If you can, very capital efficient, basically is the way to summarize it. The downside is that in many cases, what goes in there has become very common, I think, across the market. Maybe multi-strat has become really kind of a capital M, capital S. It's one kind of approach. And so there's been some connections and interrelationships between strategies that you think are uncorrelated, but if they both live inside of a multi-strat, if one sort of blows up, it might have an issue elsewhere. So the markets feel much more connected in things that historically wouldn't necessarily be connected because of that bridge.
Well, people used to talk about this as it pertained to ETFs and levered ETFs. What happens when you have more and more strategies that put dollars into the same places. But when you pair the ETFs with the rise of the multi-strat, then you do seem to have very directional markets.
I think there's directional. I think a lot of it is structural. People and even discretionary managers can use ETFs. It's a quick way to put market exposure on. They wouldn't necessarily do it through a levered ETF. There's other ways to do that if they want more exposure sort of internally. But I think part of the question I have is that the market has largely digested most of the shocks in the market post-COVID, right? And during COVID, and that was pretty quick from an actual investment perspective. Sure. It was basically March, and then everything was kind of good from a market perspective.
From a stock market perspective.
Stock market perspective, exactly. But a lot of risk assets, right? It did quite well. And the answer was to sort of redeploy. And so that's the question is we have not seen, maybe outside of 2022, kind of a sustained drawdown in the market. And so the playbook of just redeploying, re-adding or holding has worked. The question will be, and given where leverage is in the system, in something that's a bit more sustained, or maybe you get two shocks at once rather than just one at a time, that could lead to a more sustained and more accelerated sort of drawdown than we have seen in the last 5, 6, 7 years.
It's interesting because when you think about COVID, one of the reasons we came back so furiously, frankly, was because the Fed stepped in. And now we're sitting in a Fed era where there is very little desire to expand a balance sheet once again. They want to shrink it, right? Kevin Warsh wants to shrink it. So what does that mean for the market to not have that critical backstop that existed?
Well, I think they talk about that, and I think it makes sense. But I think the other time, let's have another event and see what happens, because I think liquidity helped quite a bit. It does. Maybe we overdid it, right? I think one of the lessons maybe in 2008, there was not enough liquidity deployed in the system. It helped. We got through the GFC. Maybe we overshot in 2020, leading to sort of an inflationary regime. So maybe there's a compromise in the middle there. So let's wait and see at the next crisis what actually happens. I mean, fortunately, interest rates are up. They're not at zero. So there's a little bit of room to cut versus what we had in going into COVID necessarily. So I think we're in a bit of a different regime. I don't think we can assume that liquidity will always be there. But I think depending on the context, it could be.
It's interesting. On one hand, we're talking about kind of vulnerabilities that could exist within the stock market. But the market that I actually, personally worry about more is the treasury market. Are there markets that are more vulnerable than others in your view?
Part of the problem in some of these markets, and I think we've gone through, is we just haven't stress tested the system in a while. And I think hopefully people are talking about the risks and managing around it. I'm less worried about market breakdown, but more sort of confidence issues with either market data, false information in the market. And so I think what I hope happens, and I think we kind of going back to believing in institutions and the information that institutions, who's a good provider. We have a lot of information. It's not clear we have better information. It's not clear that even with AI and all the developments, are we going to make better decisions or worse decisions with these new tools? So there's a lot of questions about trust and believability of information that I hope as we go through the AI, we start to use these technologies that we can somehow preserve the trust in the information. We can also we can question the Fed's sort of interpretation of data, other things, but let's have data that we can at least all believe in.
You're hitting on something. My next question, I was going to say, we've been doomsdaying for too long. I'm going to turn this conversation around. I want to turn it around to a place where the opportunities around AI can exist for the industry of quantitative investing, right? What has AI done for you? And then we'll get to what AI you kind of still need to watch out for here. Has it really changed the game?
Well, I think in many ways, and if you want to go back to the basic machine learning, quants have been doing that for probably a decade or more.
Yeah, let's go post ChatGPT.
And so what I underestimated was the power that some of these models can have actually on the research process itself. So moving away from sort of building models directly, but more on can we create the equivalent of a digital researcher, right, versus an organic researcher and those kinds of things. And partly for me, I think research productivity is generally going to continue to drop. But what we can do to offset that is have more researchers, and some of those researchers could be digital researchers, right? So I think that helps how we have a mindset. I think the risks are, and I think where the competitive advantage in all of this is, it's not necessarily which tool you use, which large, because I think those are rapidly developing. Once you train the models on the entire internet, everything is kind of incremental at that point. So we're going to see. Huh? Well, we can put the monetization. That's a separate business model question. But I think selfishly sitting here as a user of those models, it's a really interesting opportunity. And is the next model the best model or better model? Is it worth another investment? But the key question for me is, where does the IP sit? And I think it's more this concept of skill files or harnesses around what you put the AI to sort of teach it all of your institutional DNA. What is good research versus bad research? What do we expect? And so we've moved much more from which model to use, but rather the what you can call it a harness, skill, whatever you want to call it. How does AI deploy so that a researcher, you don't have to teach it something that a second or third year researcher would know?
I relate to this topic so much because from where I sit, we believe that good research is the heartbeat of good strategy. And so how has this changed your life? I mean, when you think about research, what of the secret sauce can you share in terms of what's been made possible for you?
It's a very exciting time with these technologies. I think we're moving from, wow, this is really cool, or sort of optimizing kind of basic processes into this more creative domain, which has been, I think, much more exciting. And what's interesting is it's not, at least in our experience, it's not that the technologies have discovered a much better or higher performing model set, but it has found things that have similar power to what we know, but are relatively uncorrelated. It's not that we've missed some big model, high sharp strategy with some historical using organic approaches, but we have missed things. And so the more you can have different views, uncorrelated views, so that's been quite interesting for us. And I did not necessarily expect that. So that's been powerful. The question I think a lot of organizations are faced with now is that everybody's sort of gotten excited. We have large adoption at Man Group in the technologies, whether it's through a more user-friendly interface or directly in some of the more esoteric or other kind of bottom-up Claude code, those kinds of things where you're interfacing in sort of an older interface. How do we
We shouldn't assume that everyone knows what this is, right? Because a lot of people don't use it yet.
Right, exactly. So, I think, there's the sort of the interface where it's like you type in a question and it answers it using a model, or you have more direct things that are writing code for you. You're interfacing with the technology in a more purer form, I guess, or more direct form. And so people that I thought would be interfacing more on the kind of the front end system are now actually using those systems. But then you get
people who've never coded are now coding.
They can code, they can do things in their day job, right, that they, historically would not have been able to, they've done sort of manually. So the positives are that's great. We have really good adoption, but then how do you actually make it practical? And so I know a lot of organizations, I think, face a similar thing where you unleash the technology, you've got big adoption, and then all of a sudden people have built 20 or 30 different kinds of information dashboards that people use, but they're all about the same. Do we really need 30 of these to analyze fund performance? Probably not. So how do you take it from individuals using it at their workstation to improve their daily existence versus, okay, collectively as a strategy point, how do we do things across engines? How do we interface with our service providers in a more agentic way? How do we interface with the entire investment process from operations, compliance, all the way into trading in the market, and how do you integrate those? And then how do you measure ROI? So one of my features and all as I'm thinking about it is you don't necessarily want to measure ROI directly today because it will look tough and it sometimes can be hard. Give it some room, but at the same time you ultimately have to show projects, things, tangible benefits that it's actually helped the organization.
What do you think are some of the most misunderstood benefits of machine learning, this new generation of AI, the new tools that we have at our disposal here?
Yeah, I think they are very powerful. And the way I describe it is imagine you're hiring the smartest person, smartest kid out of some university. They're really eager to please. They also want to achieve, right? And so you bring them into your organization and they'll give you the answer. They'll do it very, very quickly. But they may have no idea the context and have literally no experience. I think you have to think about some of these technologies as that really energetic grad you just hired and sort of think about how you would manage that person in that context. So I use that to help people sort of position it. You're going to have to really check the work. I think there's some research out there that people are more likely to check the work from a human than they are from some of these AI technologies. I think it may be the reverse you should be doing.
Have you ever asked your LLM whether it's made a mistake? The answers are remarkable.
Yeah. Oh, and what I found has been particularly useful for me is to make
it check itself even, and you find that,
and you actually create like 8 or 9 or 10 reviewers of your work, right? So a lot of what I've done is to say, okay, here's something I want to do. Create a high-level finance professor, create a well-respected hedge fund manager, find me a copy editor, find me somebody that doesn't like my work and is hypercritical of me. And it'll create these reviewers, and then you just have the reviewers, and you have the reviewers review each other. So you get this nice cycle where you feel a little bit better about yourself.
So you still need a person.
But you got to go through it, and the hallucinations, other things. And there are examples of people, and I've heard stories where you have brought in people into organizations that are very, very good, and then they sort of surrender their intellectual integrity to the machine learning models, and they forget first principles. So sometimes you can go back to employees and ask them just basic questions and see.
But this is all going back to what we've been talking about through the course of this conversation, where risk management is a critical part of things,
right,
particularly when it comes to AI. I keep telling people, maybe this is too simplistic, but one of the best ways to make money is simply not to lose it.
Yeah, absolutely.
Yeah. And so when you think about the biggest risks, it's interesting. If you had one problem to solve in AI or machine learning or big data, when it comes to the way you use technology to do your job every day as CIO of the world's largest publicly listed hedge fund, if you could have somebody go out and start a startup today that could solve your problem, what would it be?
Well, we're doing some of this internally, so I don't want to give away too good of an idea. But I think one of the things that we're underusing some of the technologies for is creating other market environments that aren't necessarily the market we've experienced, but something that could be similar. So we rely heavily, heavily on historical data, and you've got a few big dislocations in the market. But imagine I could create 10 or 20 or 30 or hundreds of similar worlds. Simulation, yeah. I know this sounds like the Matrix or some weird thing, but it's sort of multiple universes that we have so that way you can stress test your models a little more effectively, because it might not be a COVID-like event or a GFC-like event. It could be something else. Now, the hard part is to make those markets look like our markets. You have to teach it. So you're going to contaminate a little bit. But I think those are some of the, I'm really interested in that. I'm interested in bringing all of the information in the market to bear on risk questions. What is the, given all of that today, what is the probability of a market meltdown? And then and then why, which is a little bit different than a model. Historically, here you can actually ask why. So I think that's kind of interesting stuff to think about.
Greg, this has been a tremendous conversation at just the right time. That was Greg Bond. He's the CIO of Man Group, and you've been watching The Bridge by iCapital.